here the co-chairman of the M&A Private Equity Committee for ACG Chicago. Fiscal cliff, pending capital gains tax increases, sequestration, anemic economic growth, austerity measures, robust equity markets, and easy access to capital. Over the last year, each of these issues has had a significant impact on the level of M&A activity, the companies we look at, and the portfolios that we manage. At LBC Credit Partners, we provide capital for both sponsored and non-sponsored financial transactions and work with both growth and value-oriented investors. Last year, we saw significant activity from both the growth side as well as the value side, which is somewhat of an unusual occurrence, as in most years, when one camp is busy, the other is dormant. While deal activity was steady throughout the first 3 quarters of the year, the middle market enjoyed a surge of activity in the 4th quarter, owing in large part to a pull forward of transactions from sellers who are looking to avoid capital gains tax increases in 2013. As a result, activity in Q1 of 2013 has been down, pipelines are leaner, and most of the players in the M&A and private equity community are wondering what is going to happen for the remainder of the year. This has resulted in a whole new host of questions for the upcoming year. What kind of economic growth can we expect? Where is all the debt capital coming from? What has been the impact on structure and pricing? And will the markets remain this loose for the duration of the year? Given where we currently are in the economic cycle, which group is going to be more active in 2013? Growth-oriented investors or value-oriented investors? Are PEGs going to be more active on the buy side or the sell side? These are the questions we're looking to get more insight and clarity on through our program today. In order to get these answers, we brought in a stable of experts to provide their views. The program today is going to consist of an economic overview provided by Francisco Torralba from Ibbottson Associates, followed by an overview of the debt capital markets by Kent Brown from William Blair. After Kent's presentation, we're going to move to a panel and hear from private equity investors on both the growth and value side. Representing the value side will be Frank Hayes from Wynnchurch Capital, and Stephen Taslitz from Sterling Partners will provide insight from a growth-oriented investor's perspective. Moderating today's panel will be Coetzee from Baird. I know everyone's interested in the content of today's program, so we'll get started here momentarily. Before we kick off, I just want to provide a brief bio on each of the participants. I won't prevent anything, I promise. Francisco Torralba is an economist at Morningstar's Investment Management Division, which includes a registered investment advisor at Ibbottson Associates, which he joined in June of 2010. In his role as an economist, Francisco analyzes the state of the global economy, prepares reports and presentations, and participates in the Tactical Asset Allocation Committee. Francisco holds a PhD degree in economics from the University of Chicago and a bachelor's degree in economics from Universitat Pompeu Fabra in Barcelona, Spain. I apologize on the forefront. I knew I was going to butcher that pronunciation. Kent Brown is a managing director within the private capital group of William Blair and Company and specializes in raising mezzanine and senior debt capital for both public and private companies throughout the United States. Since joining Blair in 1989, Mr. Brown has focused on structuring and marketing various forms of debt capital for corporate clients in the firm in a wide variety of industries in various stages of development. Mr. Brown received his BS degree from the University of Colorado Boulder and an MBA from the University of Chicago and is a CPA. Frank Hayes is a senior partner with Wynnchurch Capital, a Chicago-based private equity fund with approximately $1 billion under management. Wynnchurch is value-oriented and specializes in underperforming and complex transactions, including corporate carve-outs, management buyouts, recapitalizations, and restructurings. Frank has been investing in institutional capital for over 20 years and has transactions totaling more than $2 billion in value. Frank is responsible for all aspects of the deal, including oversight, origination, execution, portfolio management, and exits. Frank graduated from the University of Michigan. Stephen Taslitz co-founded Sterling in 1983 as the chairman of Sterling Partners. Mr. Taslitz serves as the co-chairman of the operating committee and a member of the investment committee. Mr. Taslitz is actively involved in a number of nonprofit organizations in the community and graduated with a BS in accountancy with high honors from the University of Illinois. Finally, moderating our panel this morning is Coetzee from Baird. Chris is the head of Baird's financial sponsor group, a member of the firm's investment banking management committee. Mr. Mr. Coetzee has 23 years of investment banking experience. Since joining Baird in 1994, has provided financing and advisory services to companies in the business services, telecom, consumer, healthcare, and industrial sectors. Mr. Coetzee receives his MBA from Kellogg and holds a Bachelor of Honors degree in Financial Management and Commerce from the University of Cape Town. He is a chartered accountant and a CPA. Ladies and gentlemen, please join me in welcoming Francisco Torralba, Kent Brown, Frank Hayes, Stephen Taslitz, and Chris Coetzee.
Thank you for coming to this event. Very good morning to everyone. It's my first time at this ACG breakfast. I want to thank ACE for bringing me here today. So the talk I'm going to be giving today is my outlook for the U.S. and global economy for 2013. We only have about 20 to 25 minutes, so I'll be pretty quick in going over certain issues that probably merit a presentation of their own, but hopefully I can provide some insights. The main message for 2013 is that the weak recovery will likely continue, probably with a modest acceleration relative to 2012. 2012 was the weakest year in terms of economic growth since the end of the 2009 recession. However, policy actions, both fiscal policy and monetary policy, are still crucial to mitigate downside risks and to support growth. As an overview of my views, well, the first one I already went over it, stable growth somewhat higher than in 2012. Inflation shouldn't be a concern this year. I think that moderate growth will prevent commodity prices from rising too fast. And even if they do rise a little, high unemployment and high output gaps in advanced economies will probably keep consumer price inflation in check. Monetary policy most likely will be very loose, pretty much everywhere, with maybe a few exceptions in some emerging market economies, but generally speaking, very loose monetary conditions. Fiscal policy, as we have been hearing over the last 12 months, is starting to become contractionary in the US, meaning we are no longer, so fiscal policy is no longer supporting the economy. We are actually trying to get back on track and reduce the US deficit. In the Eurozone and the UK, fiscal policy will continue to be contractionary. Probably some support in Japan and emerging markets. The Eurozone will continue to be in recession for the best part of 2013. Fairly low risk of recession in North America and in EMs. And Japan and the UK will probably start expanding again in Q1 after some contraction at the end of 2012. I should add to that group Germany, which also contracted in Q4, will probably rebound. Not the case though for the rest of the Eurozone, especially the south of the Eurozone. The big news for 2013, I think, is that two big event risks have now a lower probability. One was the breakup of the Eurozone. The other one was a hard landing in China. And policy actions are preventing that dismal scenario. I don't believe that the problems of the Eurozone are over, but the risk of a breakup is much, much lower than it was 6 months ago or a year ago. The risk now from a geopolitical point of view is concentrated in the Middle East and North Africa. I would add there also China's disputes with Japan, Philippines, Vietnam, in that region. This picture, it looks like a red and blue game of Tetris to the people in the back. This is a heat map. It basically red means overheating, blue means, well, not overheating, like below potential. This particular picture is for advanced economies, and the idea here is no advanced economy is overheated right now. I'm including, countries like Switzerland, Australia. None of them is really overheating. Pretty much all of them are growing below potential and have been doing so for the last 2 years. The same picture for emerging markets, however, shows that there are some areas of concern that are emerging. One would be Southeast Asia, especially Philippines in that area. The other area would be South America, with special emphasis on Peru. These areas appear to be overheating. Now, this is just one variable. I don't have time to show you other variables like home prices or growth of private credit or other things that are also early warning signs of overheating. But based on all these variables, I do believe that there is a rising risk of overheating in, like I said, South America, not Brazil, but more like the Pacific coast of South America and in Southeast Asia. GDP forecast for 2013, these are forecasts by the International Monetary Fund. Basically, what they indicate is a slight pickup in growth in 2013, fairly stable growth in the US relative to 2012, big deterioration in the Eurozone, which will contract for the year as a whole, some moderation in growth in Japan, which in 2011 grew faster than expected due to the recovery from the earthquake, and some increase in activity as well in China. The big underperformers in the EM world are India and Brazil, both of which are growing below potential and below expectations a year ago. And this is another risk map for inflation, fairly low risk except for Hong Kong and Singapore and Finland. And if you look at emerging markets, I'm a bit concerned about Peru and India. The rest are either, in the rest, inflation is either not a concern or inflation is slowing down. The forecast for advanced economies is for very low inflation in 2013 and lower inflation than in 2012 for emerging markets. I already kind of gave the gist of why I have these views on inflation. I think oil prices will likely stay near $100, give and take $20, assuming no big conflicts in Iran, North Africa. In emerging markets, past increases in food commodity prices are going to increase inflation in the short term because food represents a much bigger share of households' budgets than in advanced economies. But in the medium term, like 12 years ahead, I don't think that inflation will be a big issue for emerging markets as a whole. The fading risks that I mentioned before, like I said, hard landing of China and the breakup of the Eurozone, the rising risks will be instability in the Middle East and North Africa, and the territorial disputes with China. My dark horses as event risks in 2013 will be a downgrade of France and a spike in the yields of France. In most discussions in the popular press and even in presentations by business economists, France is grouped with what they call the core of the Eurozone. If you look at external indicators, productivity indicators, growth indicators, deficit, France actually is more like Italy than it is like Germany. So I question having France in the group of the core. Of course, there's no such thing as core and periphery. It's a continuum. But I think that in that continuum, France is closer to the problem countries than it is to Germany. And I think that's a very understated or underappreciated risk right now. The second risk is the European Central Bank outright monetary transaction operations. I'm probably not remembering that acronym right now, but it is essentially the offer of the ECB to purchase sovereign debt if any country needs it to bring down yields. That program has not been tested. It's just an open offer on the table. The mere announcement of that program in July 2012 brought the sovereign yield spreads down significantly. The question is, how far would the ECB be willing to go with that program? We know that Japan has gone really far with quantitative easing, so has the Bank of England, so has the US Fed. But the ECB is a more hawkish institution than any of those other three central banks. So if bond markets bet against European sovereign debt, I am worried that the ECB will not repurchase bonds in the necessary amounts to keep yields down. That's my concern. Okay, so we get here to the U.S. outlook. I don't think most of you in the audience have not heard me speak before or read my reports, but I tend to be more pessimistic than the average, and people sometimes even in my own firm think that I'm a bit too bearish. So I'm going to try to counter that reputation by giving you reasons to be optimistic first. There are reasons to be pessimistic, which I will leave for the end, and therefore will be the things you will leave with. So reason number one is quantitative easing, most likely going to continue throughout 2013. Right now, as you know, the Fed doesn't have a deadline defined in terms of a date for the end of quantitative easing. We have a contingent end depending on the employment rate and inflation projections. Based on those projections, most likely during 2013, the Fed will continue purchasing long-term securities and will contribute to keeping long-term yields down. The effect of quantitative easing on the economy is a highly debated issue. We don't really know what's the effect on the real economy. Is it creating more jobs, or is it stimulating the growth rate? I would argue that so there are two things I would argue that QE does. One is, like I said, keep long-term yields low. The other one is bring down financial stress and market volatility. So think of QE like a value for the markets. And basically, this chart, which of course people in the back cannot see, shows that when QE ends, financial stress tends to increase, and when there is the announcement of a new round of QE, financial stress goes down. Number two reason to be optimistic is that household deleveraging has gone a long way. It's not over, but households have paid down a lot of their debt, sometimes by default on their mortgages, sometimes by really paying it down. Either way, households have now higher net worth than they had a year ago. And that smaller contribution to paying debt service and financial obligations increases disposable income and it should increase consumption. Now, of course, we have the increase in the payroll taxes at the beginning of 2013. That's a minus. Reason number 3 is one of the factors behind the low growth of payrolls was the state and local government layoffs, which now seem to be over. Federal payrolls continue to decrease, but the story there is a lot smaller because federal payrolls are so much smaller in absolute terms than state and local government payrolls. Number 4 is the recovering residential property sector. The pool of delinquent and foreclosed on properties and mortgages is going down. Home prices are no longer not only stabilized but also actually are increasing, and the mortgage delinquency rate itself is going down, which is good for the balance sheet of banks and for the health of the property sector. That also has a small wealth effect on households. Number 5, and I would say this is a smaller factor than all the other ones before, is pent-up demand for cars. Between 2008 and 2011, there were more cars going to the scrapyard than coming out of the showroom. And now that trend seems to be reversing thanks to somewhat higher confidence, easier credit conditions, and that should provide a small boost to GDP, about 0.2 to 0.5%. Oops. Number 5, and then the final reason to be optimistic is the rise in domestic oil and gas output, which will improve the trade balance. A really big share of U.S. imports is crude oil, and now that's getting smaller and smaller, and that's also a positive. The oil sector per se doesn't contribute much to employment and to GDP growth because gross value added and payrolls in those sectors is very, very small as a share of all U.S. payrolls. So the main benefit comes really from an improved trade balance. And the dark clouds in the horizon. So we have above normal unemployment rate. We're not sure why unemployment is so high relative to job openings, for example. There are stories about supply side disincentives to work, like welfare programs, the structure of the welfare programs, extended unemployment insurance benefits. There are also stories about mismatch between jobs available and the skills of the people out there who are employed. Either way, unemployment is still relatively high relative to job openings, and it's dampening household income growth. And of course, this is just a little chart showing the average household income growth before 2007 and after 2007. In fact, the average since then has been negative. Now it's starting to pick up in 2012, but clearly the average is still below what it was before. Number 2 in my list of concerns will be fiscal policy uncertainty. Today's March 1st, the sequester goes into effect. March 27, we have, so Congress needs to extend the continuing spending resolution, and if they don't, government needs to shut down all its non-essential services. Then on May 19th is the formal deadline for the debt ceiling. The Treasury, as always, will be able to pull off some accounting shenanigans and be able to continue paying the bills for a few weeks more, but sometime in July and August, we don't know exactly when, but sometime in July or August, those shenanigans run runway, and we really hit the debt ceiling. So, so of course, there's the direct effect of fiscal contraction, less money in the economy. There's also the indirect effect of uncertainty on hiring and investing by businesses. And both obviously go against the recovery. The final concern I have is corporate profits and profit margins. Both seem to have plateaued. I don't see much growth. The chart we have here is for the S&P 500, 12-month trailing earnings per share. Actually, earnings per share as a percentage of sales, so these are profit margins. But if you put up a chart of absolute profits, you will also see that they seem to have plateaued. There's always a plateau in profits and margins before a new recession. Sometimes there are plateaus that and then we see a resumption of growth. And I don't know exactly if we are in a mid-cycle low or we are nearing the end of the cycle. Based on a set of leading indicators that I follow, I don't think a recession is to be expected in the short term. Short term, I mean like 3 months. However, because of these plateau in corporate profit margins, that is one of the signs that would make me think that a recession it's likely in the next 12 months. That's kind of a scary statement to make, and there's a lot of uncertainty around it, but it's something that we need to keep an eye on. I need to keep an eye on. So that's it. So summary and concluding points: we avoided a few event risks in 2012, the hard landing of China at the middle of the Eurozone. There's been a surge, or there was a surge in investor confidence at the end of 2012, beginning of 2013, which I'm afraid may be getting ahead of economic fundamentals. 2013 will probably be another year of below potential growth, but a slight improvement relative to 2012. That's my central scenario. But inflation shouldn't be a concern. That's all.
Hello. Thanks, Ryan and Terry, for inviting us to the panel today. Hope you can see this from the back. Again, we're going to have these presentations put on the ECG website, I believe, later on today. But before we start, we thought it would be helpful to show, here it is, helpful to review some of the current trends that we're seeing in the middle market leverage finance market these days. And to that end, we've kind of assembled at least 5 key statistics here on the board. It's no secret that today's lending market is white hot. We see that in our business, primarily in the large cap end versus the middle market. But we see that some of the numbers, hopefully you can see this from the back, but I'll describe it. The first one is average LIBOR spread for single B credits. Today it's roughly 4.5%, down about 150 basis points from the average last year of about 6. That's the lowest in over 5 years. Average yield for single Bs is about 5%, down from 6.5. Again, that's the lowest ever. Percentage of large cap deals in the market that have been syndicated and flexed down during the syndication process represented about 80% of the deals in January. And that's the highest in over 7.5 years. Number of large cap deals that were done in January that were of covenant light structure represented nearly 80% of all deals, and that's the highest percentage ever. And then lastly, the amount of repricing volume, loan volume, strictly to reprice and take down the spreads, was about $44 billion in January. Month to date, last week, in February was about 37 billion. And again, that's about the highest level of volume for repricings in over 6 years. So it'll give you a sense of just how active the market is. And there we go. Overall, the market has done very well over the last 3 years since the depth of the financial crisis in 2009. You can see that in the top chart. The large cap market today is about 85% of the way back to where it was at its top in 07. Volume, at least in the large cap market, has been driven by lots of refinancing activity, and especially last year, lots of dividend recap deals. However, it's really a tale of two markets, as it were, with the middle market not rebounding quite as much in 2012. In fact, 2012 was a down year in terms of volume. And again, I think it was due in part to fewer refinancings and fewer dividend transactions being completed. You know, it's interesting when people ask us, how's the bank market doing? Perhaps they don't realize it, but what they're really asking is how is the institutional market doing? And I think unlike when most of us came into our finance careers 15 years ago or so, banks today account for a relatively small portion of the overall leveraged finance market, at least on a buy and hold basis. Today, banks directly provide and hold only about 6% of all fundings, with about 90% of the capital coming from the CLO market and other institutional investors, again, both here and abroad. So really the health and direction of the large cap market often dictates and leads what happens in the middle market, where, you know, I think I think most of us spend our time. And at the moment, at least, the health of the CLO market, institutional market, feels pretty good. The top chart here, don't know if you can see the numbers, but this shows CLO issuance since 2006, which is on a tear. After essentially zero issuance in the 09-2010 time frame, it's continued to accelerate. In fact, 2012 issuance was 4 times that, more than 4 times that, of 2011. This year, the market expects about 70 billion of issuance, up about 30-35% over 2012. The second chart here speaks to, I would say, the demand side, is best reflected in investors in these CLO vehicles accepting lower pricing, namely in the AAA tranche, the most safe tranche there. About a year ago, it was in the 160, 165 basis point range. Lately, it's in the 130, 135 basis point range, and I think the market expects it to drop further to around 120, 125 range. So, at least at the moment, all systems go. Also fueling the market has been an influx of capital on the retail side. And what you see in the first chart here is the net fund inflows into those funds. The last 13 months have been a net positive inflows collectively as everybody's searching for yield. Second chart speaks to the high yield bond market. Last year was an all-time record. Nearly $350 billion was issued, largely driven by borrowers that are trying to hit the window and lock in long-term, meaning 7 to 10 year paper, fixed rate borrowings, and using the proceeds to largely refinance existing term loans. And so the third chart here really shows term loan repayments, and that creates a problem, obviously. It all needs to be put to work, especially as many of the older vintage CLO funds are now approaching the end of their reinvestment period, from the 06, 07 vintage. The big story in the leveraged loan market since the beginning of the year has really been the surge in repricing and refinancing activity, and we see that in the top chart. Kind of jumps out at you. I don't think that you want to be a CFO later on this year talking to your board and explaining why you missed the refinancing window, and I think we see that at the top chart there. The pie chart on the bottom represents the use of proceeds, as it were, so far this year in the leveraged loan market. A good 75% of that has been directed towards refinance and repricing activity. And it's amazing. Deals are getting closed, and borrowers are looking to reprice that loan, 3-4 months right after closing. So it kind of speaks to how aggressive, again, probably more so on the large cap side than the middle market side, but it's how aggressive the market is. We are starting to see some pushback though in recent weeks. I think probably the poster child of that was a deal for DuPont Performance Coatings. It's a Carlisle LBO, fairly large, came to market early part of the year, priced their leverage loan on January 17, closed on February 1st, and the bankers went out 2 to 3 days later looking to reprice it further down. Now it was unsuccessful, but again, it speaks to the aggressiveness that bankers are pushing for in the market. I think with a little bit less pressure perhaps than it was at the beginning of the year with the announcement of Dell Computer and Heinz and other large LBO deals coming to market, and large term loan Bs that will have to be sopped up by the CLO market. So a little bit less pressure to put that money to work, at least in the middle market. We've also seen a lot of new capital coming into the middle market. Top chart here shows really as investors are looking for yield, searching for yield, they're going into vehicles that promise that yield, and BDCs is one such vehicle. Top chart shows the amount of equity issuance by business development corps, either in an IPO or a follow-on offering format. Between public and non-public BDCs last year, there was over $5 billion of capital that was raised, primarily earmarked for the middle market. We've also seen, especially here locally, some new, relatively new, or at least freshly capitalized non-BDC players targeting the middle market. Guys that come to mind, Babson Capital established a senior group here. Kane Anderson's senior strategy has seen a lot of deal flow. We see Freeport Financial with backing of Aldous now seems to be more active. And even on the credit opportunity side, we've seen folks like KKR, TPG, TCW, the old Regiment Capital, you guys may be familiar with. Lots of capital that needs to be deployed and principally earmarked to the middle market. Kind of tongue-in-cheek here, but as many people in this room can attest to, it's tough to be a lender right now. Pipelines are thin, LBO activity is light, competition is fierce. So when all that happens, people start revving up the prospecting engine, and they call people like me. And as a result, I get lots of free coffee, lots of free lunches here these days as people try to figure out, where can I get incremental deal flow. We call this kind of the lunch-o-meter. It sits outside. Sits right outside my office. But what they're telling us is a couple of things. 2008, early part of 2013 activity was pulled forward into the fourth quarter. Be it for dividends or sale mandates, pipelines are thinner, competition is tough, be it from BDCs and credit op funds or on the structure side. We're seeing a lot of competition on the unit for the form of Wynnchurch. If you come to market today with a clean, solid deal, it's getting white hot attention. We've got 2 such deals in the market right now, and it's very, very competitive. And lastly there, I think bankers have been telling us, they'll somewhat readily concede on pricing because they view that as temporary, perhaps. And they get another bite at the apple to maybe boost it later if there's an amendment request or things of that sort. They're trying to hold tight on structure though. Some guys not as successful as others. A few comments on pricing and structure. First chart here shows LIBOR-based pricing for single Bs. Pricing is down dramatically, especially in the last couple of months. Good 250 basis point drop over the last 18 to 24 months. Again, these are for single B credits. Bottom left speaks to leverage, which for middle market deals, it's really in the mid-4s. Leverage is up certainly from where it was in the bottom point of 2009, but not yet up to the 2006-2007 levels. And lastly, the equity equity contributions remain fairly stable. I think reflecting the fact that there's still a lot of dry powder left with private equity firms, number one, and guys are still paying relatively fulsome purchase prices on the deals that do come to market. And we're also seeing some pressure on the covenant side as well. 3 charts kind of speak to that. The first one here represents covenant light issuance, which is up significantly year over year for the last 3 years. And I think it's part to the fact that I think people figured out that covenant lights aren't as bad as maybe what they were suggested to be back in 2009. They actually weathered the recession fairly well. The second chart reflects that about 30% of all large cap first lien deals that are done have only one maintenance financial covenant as part of the covenant package, and it's up from 10% in 2010. Third chart here shows simply the number of covenants that you'll find in a covenant package for first lien deals, and that has declined from just under 3 to about a little bit under 2 covenants per deal. Again, we haven't seen quite as much pressure where we spend our time in the middle market, but perhaps that's just coming. And then lastly, our view is that the credit markets should remain fairly robust for the balance of the year, absent any unseen shocks to the system, be they economic, something that happens in Europe, corporate earnings surprises, or a fall off in the broader market. But at the moment, the markets feel pretty good. Hope they stay that way. That's it.
Ken, thanks very much for your insightful presentations. Thought what we would do here is start off with having Frank and Stephen give you a little bit on their firms so you can get some context here for how they go about things. Frank, why don't we start off with you?
Good morning, everyone. I appreciate very much the opportunity to speak to you today. I know myself and one of my team members has talked to many of you, so I will try to keep this opening commercial short. We manage at Wynnchurch a little over $1 billion in capital. Since our founding 13 years ago, we've bought 41 businesses with over $5 million in revenue. Today, we've got 22 companies in our portfolio today with about $3.5 million in revenue and $320 million of EBITDA. Our target companies are really those with mature business models that are undergoing some level of current operational, financial, or market challenge or stress. These can be underperformers, non-core corporate carve-outs, out of favor sectors, and even bankruptcies we spend a fair amount of time in. We target companies with revenues of anywhere from 50 to 500 million, and we really play in the industrial manufacturing, business services, and logistics space in a B2B environment. Simply put, we seek to identify unique, inherently well-positioned companies, but undergoing some level of underperformance, and because of that underperformance, be able to buy at attractive below-market values. And those situations also need to have possess very specific value creation opportunities, which is really the cornerstone of our investment thesis.
Stephen, how about your firm?
So we've been in business for 30 years. Started out as entrepreneurs building businesses, and then reluctantly got into the committed capital business when the world shifted, and it just seemed like the tax laws and everything indicated it was the way to go. So since 2001, we've raised 7 institutional funds. We are currently investing out of 2 funds, a smaller fund, a $250 million fund, and a larger fund, a $1 billion fund. We have about $7 billion under management. We have 30 portfolio companies. Our portfolios range in size from 20 million in revenue to 3 billion plus in revenue. We tend to partner with entrepreneurs who are looking for a lot of the operational expertise that we bring to the table, and really looking at different levers that we pull on how do we build great growth businesses. We like building businesses, that's what we do. We tend to play well with sellers and management teams, and that's kind of what we do.
Well, thank you for that. Maybe, Stephen, you could follow up here based on what you heard from Cisco, comment on the economic outlook. How do you think about that in the context of your strategy?
In regards to our strategy, we have a couple global businesses, and our global businesses are feeling the effects everyone would think that they're feeling. Things in Asia are good, still really good. We're actually bullish. Just you were saying things. We're doing a bunch in Singapore, and we think it's where everybody's going to go, and everyone's pulling out of Hong Kong. It's just tons of opportunities there. Low tax rates, encourage entrepreneurial behavior, and more and more people are going to move there. That's kind of one of our themes. People follow where tax rates are low. So when we look at where we're putting corporate offices and what we're seeing lots of opportunities in Texas, lots of opportunities in Florida. People don't want to pay 10, 11%, 13.3% state taxes in California. And so entrepreneurs and people that we work with, and when we're thinking of setting up corporate headquarters, that's kind of where we're putting them. Our business is going to be, we were up 24% this year. Our flashes will hopefully, if we hit our budgets or around that, we should be up in the mid to high 20s again this year. And we're seeing growth in just kind of niches. Overall, I think the growth is anemic in the country, but you can always find interesting business models that you can replicate, new products, new services. We play in education, healthcare, and business services. So in business services might be anything from, we invested in a company in the pipeline space, we x-ray pipeline fittings, and that company's booming as shale plays are booming. And so, we tend to think about theses, investment theses that we like, major trends, try and find niches, business models, and proactively try and partner with management teams that look and like the way we feel and think about how to build great businesses. So overall, I'd say, I think this year's going to be good. The one thing that scares me that no one's mentioned is I'm still really concerned about what's going to happen with Iran and what's going on in the Middle East. I think that, there are black swan events all around us that could just derail this fragile recovery. And so the one thing none of us know is when something really bad's going to happen. And we live in a crazy world, and stuff can happen. So I think we are just living on the precipice, because we are so fragile right now, of just a potential huge problem. If we get lucky and things skate by, then I think it'll be an A year. The only thing I like, and I've been telling these guys, is I'm a big believer in the stock market these days. I think we're in the early phases of a good stock market recovery, especially in the IPO market. So we've got a lot going on there too.
Well, it could open up a whole other couple of hours of conversation there, Stephen. We'll, just sticking on the local economy here, Frank, interested in, as you think about the economic outlook, both in terms of how it impacts your portfolio as you think about 13 and 14, and then prospects for your investment strategy.
First off, I have no idea what's going on in the public markets, so you're not going to get any insights from me today on that. I can barely manage my own portfolio, let alone trying to figure out where the public markets are going nowadays. But overall, I think with the firm, we feel that the economic outlook is improving. It's going to be slow, modest growth, but it's improving overall. We're seeing this across our portfolio. We're seeing, for the first time in many years, pricing firming up across the board. We're seeing unit volumes start to improve. We're actually seeing some labor shortages in some skilled labor areas within the plants, which is all a good sign of us that things are starting to improve. I think that what Ken had to say about the credit markets is also going to help us out overall. And this bodes well for Wynnchurch, because we grow our businesses in low growth environments. We are all about fixing the operations and strategy. Growth is a secondary element of our strategy, and really a byproduct of fixing the underlying cost structures of the business and just becoming more competitive, and with that being a better competitor and able to take a share. We're excited. I kind of like where we are with this economy. There's half the people saying it's going to tank, and the other half saying it's going to take off, which is great for us because there's lots of uncertainty, and it helps us as a value buyer to be able to find properties. So from a portfolio perspective, we feel very good about it. From an investing perspective, likewise, we see the strategics pruning non-core assets, mainly because they're seeing delayed sector recoveries, so they're tired of waiting for the recoveries to happen. And we bought some very attractive building products businesses this past year, where literally the corporate parent had been writing checks on money-losing businesses for 5 years. It seemed like an odd time for us for them to sell it, just on the cusp of recovery, but nonetheless we took advantage of that when we would come in at very attractive liquidation of the assets sort of valuations. There's also just a general concern about overall growth, and so with that, the corporations are really looking hard at each of their assets and deciding what can they keep, what do they need to shed in order to appeal to the broader market investors. And I think lastly, there's this general fatigue that's set in on a lot of management teams because they've been going at this for 5 years without really much to show for it, and so there's a lot of activity from the corporate side of things. So we feel good about where the economy is, and we think that this is going to be another solid year for Wynnchurch in our value investing.
Well, it sounds like both you and Stephen have provided an environment here that continues to be conducive to deal activity. You know, one of the things that we're all hearing is that Q1 has started off with lackluster M&A activity. Ken, you and I talked a little bit about the debt markets traditionally have been a real signal as to deal activity, and everything you said would point to us, sitting in an environment in Q1 here of strong M&A activity, which we haven't been seeing. Maybe you can just comment on that, and then I'd like to go over to Stephen and Frank and talk a little bit about what they're seeing in terms of actual deal activity.
Sure. At least if you talk around our firm, I think the belief is that it's not so much a lull in activity right now as it's a bit of an air pocket. Again, a lot of deals that would have naturally been 2013 flow got pulled into first or the second half of 2012. I think we closed 156 transactions last year. Most of those sell-side M&As. 115 of those deals came in the second half. So the vast majority of it, and I think that creates a little air pocket. It's really timing, I think, more than anything. Talked to our head of M&A yesterday. He was saying that as of right now, we have about 160 pitches that are scheduled over the next 90 days. So there's a lot of flow coming. It just hasn't arrived in blue books on people's desks. So, but it feels pretty good so far.
So we're in an air pocket then. Okay, good to hear, Kent. And I guess, Stephen, from your perspective, how's activity looking?
So I agree with you. We are busy. We were busy last year. We closed 5 new platform deals. We only will do 3 more deals this year, and I think we have 4 deals under letter of intent. So we've got enough going on to match what we're doing, but there's just a lot of private equity firms out there that are getting pressure from their LPs to sell portfolio companies still. And if you want to go raise money, you need to generate liquidity for your investors. And so people are doing it through this refinance boom. But people are going to sell businesses. I think if you had something that was ready to sell, you sold it last year. But sometimes things you couldn't get it done. So I think that the second half of the year will be good. With the debt markets being priced finally where they should be priced. It should have been priced that way 3 or 4 years ago. You look at where interest rates were, and from a risk-reward point of view, the debt guys were getting better deals than everybody else in regards to growth, and so now I think that's where it should be. And there's plenty of private equity. I think the number of businesses that are owned by private equity firms is so huge, and knowing that they are not permanent owners of businesses, there will be volume and it will come back.
Frank, how about you guys? How are you seeing deal flow? And one other comment that could be helpful here is if you can interject on what you're seeing from the strategic wise.
Yeah, first off, I'd say in 2012, with a little bit of perspective, there was an extraordinary year for us. Very busy, a bit overwhelming at times. We closed 7 new platform deals and 3 new add-on acquisitions, which is about double the level of activity that we normally have for a firm of our size. And there were probably another 3 deals that we had in the letter of intent that we could have gotten done if we didn't choose to pull away for a variety of reasons. So coming off of that, anything is going to look pretty modest, but we are seeing a slowdown in the first quarter of 2013. All of our investment banking friends tell us that the pitch activity is up and there's going to be a lot of product out in the second, third quarter, so we're believing in that. But because of our value orientation and the types of deals we do, it's really not driven by the level of investment banker pitch activity. It's a bit more opportunistic. So we're really, we're really targeting out of favor sectors to try to get sort of an early jump on some of those businesses that might be underperforming. We think that there's in our 13 years of doing this, we've never had a year where we haven't been able to buy some underperforming businesses. I think that's the common thing here is that corporate America will always have some part of their business that isn't going well, and or some bad management along the way. So we're reliant on that to a certain degree. As to strategics, we don't really see them in our processes. In fact, we typically don't have more than 5 other groups really looking hard at the assets that we buy, and usually it comes down to 2 of us. Strategics just don't like messy situations. There's not a single business development guy who wants to take the career risk of buying a troubled property and have it be toxic and affect the rest of the business. So we never see them. And then from a sales side of things, the bankers don't really want to deal with them either because they're slow and they're just not decisive enough in the troubled situations where a sense of urgency is really required to get these things to close quick. And I would say though, conversely, in selling to strategics, we've had 2 properties sold last year. We've got 2 in the market right now, and 3 of those will go to strategics. So when we're buying, we don't see them. When we're selling, we love to see them.
Stephen, how about you guys? Do you see a lot of strategic activity?
Yes, but we sold more of our businesses to private equity folks last year than we would have thought. And one of the reasons we're actually interested in the IPO market is the valuation spread has widened to where it was what I remember was growing up, and what you can get if you have a good, healthy, growing business, getting paid a forward multiple, called 11, 12, 13, 2014 or 2013 numbers versus selling something at like a 10 on 2012, the gaps can be so wide, and if you love the businesses, if you've invested over the past 3 or 4 years building a great business with predictable growth, it's worth taking it public. So the strategics, we see them. I think they choke on the prices we want for some of our businesses, and so that's kind of why we're leaning to this heavy IPO route now that the market's open, and we're hoping that is going to be a really nice exit opportunity for us over the next few years to really capture some of the value that we put into building some of these businesses.
Well, I think we as a firm tend to share your views on the future of the IPO market over the next couple of years. Just interested, just to give us a sense, maybe a little bit of a segue there, to give us a sense, in terms of the size of businesses that you'd be comfortable taking into the public market, and then just is it the fact that there's a good spread here with the low interest rate environment that you view as the IPO market being particularly attractive?
Oh, okay. So the size companies we're talking about taking public, the smallest we would do is 500 million in enterprise value. So one would be that, a couple are in the $1 billion range, one's 2.5 billion hopefully, and one is about 8 billion. So, you know, these are a little bit bigger businesses. They didn't start that way, but that's where they are. Why has the stock market come back, and why am I bullish on the stock market? I'm older than probably most of you, and things just get oversold and undersold, and people hated the stock market for a long time, and now I just think, you know, people have forgotten, you know, how burned they've gotten, you know, 4 or 5 years ago, and people are looking to put their money places, and, you know, I just think it just smells and feels to me like we're early on in the game. There's plenty of capital in the market. The pricing is good if you have these kind of good growing businesses, you know, highly repeatable business models, growthy, and so, I don't know, it's great. And again, I just think we're in the early innings. I think that, you know, it would not shock me if 3, 4, 5 years from now, there were a bunch, you know, the market even got to the point where guys were taking, you know, $150, $200 million enterprise companies public again. I just think we're just kind of in that business building foundation mode in the country again. I think that's just what's going to happen.
Well, and it seems to me that it is also somewhat sector specific. One of the things, Francisco, that I didn't hear too much of in your discussion, although you referenced it a little, maybe we could just get some feedback on kind of this increased regulatory environment and what impact you think that might have on 2013 and 14, and then I'm just interested in Frank and Stephen's views on the impact of the regulatory environment as well.
Sure. Businesses hate regulations and taxes. They hate spending time and money on them or paying other people to comply with them or to get around them. The National Federation of Independent Businesses conducts a survey where they ask business managers or business owners, what's the most important problem for you? In January, that was government regulations and red tape tied with taxes. It used to be poor sales was the most important problem, and a couple of months or 3 months ago, that came second. I think regulation is necessary, but better regulation is not the same as more regulation. I think a prime example of that would be the Volcker rule, the development that the government is making of that Volcker rule. I don't know the M&A and private equity sector as well as you do, but to the extent that there is more regulation in the financial sector that affects them, the private equity and the M&A world certainly is not conducive to more deals or to more activity.
Right?
With respect to the sequestration that's going on today, for us it doesn't really affect us. We've got a couple of defense platforms in our portfolio, but these are all largely non-discretionary programs where funds have been earmarked, and that was part of the original investment thesis. Is we wanted to make sure that we're not going to be subject to any movements in defense because we just got into these in the last year, so it was a big part of our original underwriting. With respect to overall, regulation, certainly less is better for us. We're trying to process what the Affordable Care Act means to all of our portfolio companies. I think our CFOs are all scratching their heads right now to figure out what the hell they're really going to do. So that's stay tuned. Maybe next year we'll have a better sense of what that means to all of us. We're not involved in government services or healthcare, any of the areas where there's a heavy amount of regulation that can really move the needle quickly on the top line by the stroke of a pen. As I said, all of ours are industrial businesses, automotive, heavy truck, niche manufacturing, and so we're able to get by pretty well without the sort of risk of what Washington D.C. is going to do from one day to the next.
So we live and die by it a lot, and I grew up a lifelong Democrat, and recently I've changed sides. I'm a big believer that big is bad, big is inefficient, and scrappy wins. David always beats Goliath, and I believe that the government's hostility towards business is a cancer in our country. I think it is a terrible, terrible thing. I can give you guys story after story of just ridiculous overregulation, story about overreaching attorneys for the government, targeting private equity firms and holding them up because they know they need liquidity. So they act, it's like you're dealing with the mafia, members of the United States government. It's terrible. You're embarrassed to live in a country, quite frankly, that people behave the way they behave, especially in the healthcare arena, in the education environment, where you've got lawyers for the government, going back 8 years before we own the business, saying somebody did this, and therefore, we want you to pay us, 3 times revenue what could have happened based upon something that is just ridiculous. Now, that being said, what the government taketh from you, the government can give you. So we have a mortgage business. We got into it absolutely the wrong time, and we've killed it the last year and a half. But then all of a sudden the government realizes that they're helping you make money with quantitative easing, and then we get kind of nonsense where states will come after us for stuff that happened again. How the loan officer put something on a website and say, write us a check for $20 million. So it's a money grab out there by a lot of the states, a lot of these regulators. I think it's a huge, huge, huge problem. I think our current president just adds to it by, kind of his rhetoric. And it's a big problem. I think it's a big problem, and it's getting worse. You don't want to do stock deals, for sure.
Well,
I think we should all welcome Stephen to the bright side.
I mean, it's true. I mean, it's just a fact. If you go to these things and you see what goes on, if you own companies and deal with what really goes on, running businesses in some of these sectors, it is just brutal.
well, maybe what we can do here is just we can take 1 or 2 questions. Just one follow-up on that, interested with that backdrop, Frank and Stephen. What sectors in your mind are the better areas to be spending time in today?
Well, I like the education sector. Everyone hates it now, and now is a great time to play it. I think we're in the early innings of transformation. I think Obama got this one right. It's one of the few. I think we're in one of the early innings of how people learn, how we're going to distribute knowledge, how accreditation is going to work. I think finally the teachers' unions are starting to get busted up. Hooray. And we will offer different opportunities to families and kids with different learning styles, different learning methods. So love education right now. I think healthcare is pricey. We're sellers of healthcare businesses. We think they're overpriced. And we really like energy services right now and big data. We think there are great opportunities in big data and energy services.
Frank, how about you guys?
Well, after this, I'm steering clear of regulated. Thankfully, we've dodged it for 13 years. I'm sure we'll be able to continue on without it. But we look a lot at cycles. We're not afraid to invest in cyclical businesses. It's really a part of what we do. And so, auto is 3.5 years into its run. I'd be very skeptical investing in auto right now. Heavy truck has a little bit of legs left to it, but that's on the top end of its curve, we think. Non-res construction is probably a year or so into its recovery, so that's a good attractive area. We spent a lot of time on building products in the last year, trying to get as many investments in our portfolio as we can. I think it's a fantastic time to be investing in building products. and we were able to buy 2 companies last year. So defense, we're also, we're contrarian. So everybody's running away from defense right now. We're going in and trying to make sure we do it smart with the right advisors. But that's usually where we play best. We pick around the scraps and try to pick things up where everybody else is running. So I would say building products, defense, non-res construction, and then there's just a number of niche manufacturing businesses out there whereby you're really looking for great business models that are just underperforming. So it's not so much sector driven as much as it is what are the attributes of how the company's positioned, what it is that they do. Is there something unique about them that just needs to be nourished a little bit because it just has the wrong leadership team in place. So not so much sector driven, but profile driven.
Ken, maybe I could ask you a quick follow-up on that. With the various sectors that Frank mentioned, Stephen mentioned, are there any particular sectors that are tougher to finance today?
In our practice, it's pretty rare for us to get a straight up the middle clean deal. People aren't paying us to raise capital for companies that may be tougher to finance to begin with. I would say asset-light companies always have a special challenge. Anything in the professional services, consulting, kind of human services businesses are really tough. There's been some big, flame-ups in that sector. I would say specialty finance companies. We do a lot of capital raising for companies in that sector, and that's been tougher than it is actually right now. Subprime auto and whatnot has been doing very good, but it's fine. So.
Okay, so I think we're going to field some questions from the audience. Is there already? Yep.
A question for Frank and Steve. So the proliferation of secondary transactions, sponsor, how are you guys able to manage selling, or with your LPs, selling a company where an LP is also in the fund that's buying that company?
I'll repeat the question. The question is about secondary trades, sponsored trades. How do you manage that relative to your LPs?
Our LPs don't care. We go through very rigorous processes in regards to how we value our portfolio. If we run a process and they happen to be on the other side of the table with a buyer who has a different point of view about what they can do with the business. Quite frankly, we hope we're selling great businesses and the people that buy our businesses are going to make a ton of money. I mean, our goal is to build great businesses. And so at some point we've got to sell them. That's our business model. And we hope the guys who buy them do well. We think that bodes well for us. So it is what it is.
Yeah, it's not an issue for us at all. In fact, it's really part of the natural life cycle of the businesses that we buy. We're buying bust businesses typically. We're bringing in new management, we're changing those and fixing those. It's, and the private equity community is a big buyer, right, in addition to strategics. But we've never gotten a single comment from an LP on the issue. I think they expect it to a certain degree.
Yeah, the one thing I'll add at Baird, what we have seen is, a number of these businesses are going through their fourth and their fifth trade, private equity firm. And we've started to bump up against it a little, kind of on that fourth or fifth trade, where a private equity firm, if they end up being one of the last 2 or 3 bidders on a deal, where they're acquiring a business from another private equity firm that has got very similar LPs because they've got very similar investing styles, we've seen them pull back because their LPs clearly are concerned about a trade from one firm to another where there's a huge overlap in the LP base. But that's the only instance we've seen. Any other questions? Yep.
For both Frank and Steve, talk about some of the specific companies you own. We're going to talk about the generic sense of company.
I'll give a couple. one company we own is a company called IO Data Centers, and hopefully you'll all be hearing about it. It's going to go public, we hope, in July. So we back some entrepreneurs who, this is our second time around with them, who used to build data centers the old-fashioned way, and developed a modular overlay where you can now go in and instead of spending $150 million up front, as you need more processing capabilities, you can put data centers in that you can build them that way. You can drop them in parking lots. But the exciting part about the business is the software overlay. There's a huge cyber terrorism thing going on that some of you know about, but it's really one of the biggest problems we're facing as a country right now, the amount of cyber terrorism, and it's attacking our banking system and our power grids and all sorts of things. This company has a software overlay that allows the chief information officers to understand what software applications are running on what servers, how much power they're drawing, are they being attacked, are they running the way they should, and by pressing a button, we can move the application to another server in another location, maybe with less power, that's not under attack, and provide a front end. So it's, you know, big data, growth, unique technology, hardware, software, predictable, sticky businesses, kind of a gotta-have product, and so that's an interesting business that we own.
I would say rather than I don't have anything that sexy. We don't invest in sexy businesses, but I would say more than variability is the interesting thing about our portfolio. We've got a salt business in Saskatoon, Saskatchewan, and I'm convinced we got it because nobody wanted to go to Saskatchewan to participate in the process. But it's just an amazing cash flowing business, and it's doing exceptionally well here into the deal. We just bought from Mueller Water Products, the U.S. pipe business out of Alabama, and that's one of those building products companies that we all need. It's these big ductile iron pipe products for new water systems. And for the last 5 years, the corporate parent had been writing checks because it just money losers, no home starts, and we caught it at the cusp of the turn. And it's been a tremendous performer for us 9 months into the deal. And we haven't even seen volumes move yet. It's largely because we've got a terrific management team that we put in place there, and they've been able to implement some strategies to really turn the performance. Literally the first month we bought it, they were making money. From those not sexy businesses too, we manufacture the gearbox sets for the Chinook and Apache helicopters at North Star Aerospace. That's a mission critical got to have. You're not shipping a Chinook or an Apache without our gearbox. And nobody else in the world can manufacture the tolerance levels for the specialty metals that we use in our manufacturing process. To Vertec in Detroit, which is a company we bought out of bankruptcy, it wasn't the problem. Its parent went into bankruptcy, so it of course got sucked into bankruptcy. But they provide the missile defense systems for all of the Western allies, Israel, Saudi Arabia, Japan, all the most state-of-the-art missile defense systems they're providing some fabricated components for. So I think the common element there is this has got to be a unique product. It's got to be mission critical. We like to say low cost of product, high cost of failure, with tremendous switching costs. So again, it really gets to the attributes of this. We don't care what it looks like. The less sexy, the better, and it attracts more people.
So we've probably got time for one more question. If it's another round, we'll take that privately up there. All right. There we go.
Yes, really, John. Epicenter around big data. Do you see this draw towards big data? What type of impact do you have? Do you see that having a portfolio of companies or operations? Do you see it as a big opportunity to increase the top line growth, analytics? Do you see it kind of eroding some of the benefits of organizations? How do you see those things kind of play out?
Okay, so basically, I can break it down into a number of parts. The first thing is, the reason that we got involved with our data center business to begin with was, if you look at the IT stack, that was, data centers was the one part of the IT stack where costs were just going up. I think data centers are now 43% the cost of most IT budgets were 10 years ago, it was like 12 or something. So there's a massive increase in data storage, processing, backing up, and yet things weren't being built differently. I'm hoping that with this business that we've invested in and what it's doing, we're actually going to be able to drive that part of the IT stack cost down. So the ability to actually use big data and do things much more efficiently, much more cost effectively will help all companies. So I think there's going to be a trend in data storage costs going down, looking at all sorts of other technologies in the data space. So if costs go down and you can manage the energy efficiency, you don't have to build in as much redundancy, and don't have to be in certain facilities, you're going to be able to generate data, use it, store it, manipulate it at a fraction of the cost and at high speed. So I think that's the way the world is going. I mean, all the statistics are every year what we produce as much data as we have in the history of man up to that. So there's just massive amounts of storage a product being created that people want to store and manipulate. And so I just think, again, that's just the way the world's going, and with video compression and everything, this is what's going to happen.
We don't need data centers.
Okay, well, I think that's the conclusion of our discussion. Thanks very much for attending, and appreciate it.